Okay, thank you very much for having us here. This is joint work with Zhiguo, who is somewhere, there he is, and Konstantin. Let me just tell you a little bit about what this paper is about. So just here are some observations about US Treasury bonds. US Treasury bonds are kind of the world's safe asset. And what I mean by that, for example, is if you look at reserve currency portfolios around the world, you'll see lots in US Treasury bonds. That's kind of a quantity fact. If you look at asset prices, I have this work with Annette Wissing-Jorgensen that shows there's this extra value that investors assign to US Treasury bonds, what we call a convenience yield. And then there's this third thing, which is that it looks like in bad times, the value of US Treasury bonds rises. So a particularly good example of this is if you think back to the date when Lehman fails, by any reasonable estimate, you would have guessed that the present value of fiscal liabilities that show up in the US government just blew up by several $1 trillion. But yet, when you go look at the valuation of US government bonds, they rise in value. US T-bills fall, the bond yields fall across the spectrum. If this was Greece, you would have said, easily have guessed that bond yields would have risen. So there's something special about being kind of the world's safe asset. Investors rush to it at bad times. It looks like it has a high value. And the truth is, the US debt to GDP ratio, US fiscal position has worsened dramatically over the last 15 years, and yet all these facts about US government bonds remain true. Okay? If you think back historically and think back what historians talk about the reserve currency, historians will say gold, say prior to 1850, then after 1850 it was probably the UK government bond, and then there's the interwar period where it was probably the US bond and the UK bond. Okay? And I'll come back and talk about these things. So these are kind of the facts that we'd like to be discussing. And the kind of departure point, the angle of this analysis is to notice that when we think about all of the safe assets that investors hold, they're all financially engineered. So think of government bonds, think of bank debt, think of money. These are all financially engineered safe assets. And in particular, they all have a common component, which is their valuation is coordination dependent. So that's really the kind of the angle that we're going to take into this paper. We're going to pursue this idea that that valuation of a safe asset is coordination dependent. Its safety is endogenous, and if lots of investors think an asset's going to be safe, it's going to be sort of self-consistently safe. And that's kind of the angle I'm going to take, and I'll show you thinking about that gives us some insight into what's happening up here. Okay, so we're going to build a model, and as I've said to you already, the model is going to build off of coordination dependence. So the way we're going to pursue this is kind of the Morris-Shin angle of thinking about multiple equilibrium and selection. So we'll break common knowledge. I'll take you through the model in a bit. And the key kind of economics in this model comes off of a trade-off between two things. On the one hand, a strategic complementarity, that is, if you're doing something, I want to do it too. And that's coordination. That's going to be one factor in the model. And the second is a strategic substitutability, which is if you're buying asset A, I don't really want to buy asset A because it's pushing up the price. So there's this trade-off between these two things that's going to generate all of our results. Okay, so main results. The first result that comes out is an idea that to me and to us seems very natural, which is that size, float. The float of outstanding bonds is actually an important component of the determination of what is a safe asset. So why is the US Treasury bond the safe asset of the world? In short, because there's nowhere else to go. There's a lot of it. If the whole world was to sort of shift into buying Canadian government bonds, which are probably safer in some respects, it just wouldn't work. There's too little of it outstanding. So there's nowhere else to go, and that's quite important. And the second thing that also I think is quite intuitive, that in this question of what is a safe asset, what matters is relatives, not absolutes. Right? You just have to be, you can be bad, you just have to be better than everybody else. Okay? And that's also going to come out of the model. All right. So I'll take you through and explain those results to you. I'll show you the negative weight of the safe asset. I'll probably go through this very quickly. It's done more in the paper. And I want to spend just the last 5 minutes of this talk talking about Eurobonds. So there are these proposals in Europe about trying to create a common Eurobond. And one central idea behind these proposals is that you get these patterns in Europe when things blow up, German Bund yields go down, and all the peripheral country yields go up. So there's sort of a flight to safety that generates fiscal benefits to Germany, but not to anyone else. And one idea behind the Eurobonds is maybe you can spread these. And I'll show you that actually our model is a very nice way to analyze a Eurobond proposal. Okay, so here's the model. I should kind of tell you right in advance what you're looking for. It's a static model. It's a real model. Okay, so just consumption goods, no money, nothing like that. I'm not going to be able to talk about exchange rates, but I think I can talk about why an asset is safe. Okay, so static, real. There's two sides of the model. The investor side, investors indexed by J. There's a measure, 1 plus F of investors. They each have a unit of the good that they have to invest. They have to store value forward. The investors are risk neutral, and as I said, they have to invest it. Okay, and in particular, they can only invest it in one of two places. There's two countries, sovereign debt of country 1, sovereign debt of country 2. You invest in one of those two countries. Okay, that's the only investment alternatives available in this world. Pretty stark, but if you look at the paper, you'll understand what else is going on there. Okay, so as I said, two countries. Think of these two countries as the US and Canada. For our analysis, I'm just going to think of country 1 as the US, and I'm going to normalize its size. Size here refers to the float, the outstanding amount of bonds, to be 1. And country 2 has float of S, which is less than 1. Okay, so US, Canada, country 2, Canada, country 1, US. Debt values, the faces of debt is exogenous. What's endogenous is the price. All right. The model has coordination. I've already flagged that for you. The way we're going to build in coordination is through default. So we're going to build in a sort of standard rollover risk model. It's in a static setting, but you'll see that it has the kind of basic idea of coordination coming off of rollover. All right, so imagine that a country has some amount of bonds outstanding SI that it has to roll over. To roll over, it has funds from the fiscal side, SI theta I. This is some fiscal surplus, taxes that it can raise. And then it issues some bonds, and the proceeds it used to roll over the bonds. Okay, so it issues bonds SI at price PI, so that's the proceeds it receives. If it doesn't have enough money, it defaults on its debt. You can see here there's clearly a circularity here. The price PI shows up in the default condition, and the decision to buy debt will depend upon the price PI. Okay, I'll explain this further in a second. SI theta I is also exogenous to the model. It's the fiscal fundamentals. I think the clearest way to understand this model is it's just fiscal surplus. It's tax revenues, less payments. But you can reinterpret the model with some kind of appropriate relabeling to think of it as including foreign reserves, or if the underlying debt is domestically denominated debt, you can think of this as the amount you can raise via inflating the debt. Okay, all of that can fit into the model, but for all of the algebra of the model, just think of this as a real model in which this is just fiscal surplus. Okay. All right, and for most of the talk, I'm going to set recovery and default to be 0. So let me just start with a special case of this model, which will kind of outline the basic economics of the model. I can rewrite this condition for default as a no default condition, which is that the price you raise when you sell off your debt has to be bigger than your funding need. Your funding need I've written as theta I is the amount you get from your fiscal surplus. You have to roll over 1. So 1 minus theta I is your funding need times SI, which is the amount of bonds outstanding. Okay, so if SI PI is bigger than SI 1 minus theta I, you're able to roll over your bonds. And if you look at this, you can clearly see there's a multiple equilibrium. If nobody thinks you can roll over your bonds, PI is going to be low, and you're going to fail. All right. So let's take the following parameterization. Let's suppose that the total amount of funds available from the investor side, the aggregate amount of funds looking to invest in sovereign debt, is big enough to cover all of the funding needs of the economy of both countries. 1 minus theta 1, country 1, S times 1 minus theta 2, country 2. In this special case, there are 3 equilibria. There's an equilibrium 1 in which country 1 is safe. Everyone rushes to buy country 1. That ensures price of country 1 is high. No one buys country 2. That country 2's price is low. Country 2 defaults. Country 1 doesn't default. There's the reverse equilibrium of that, where everyone buys country 2. And then there's a both country equilibrium in which everyone kind of splits their money just in the right proportions so that they keep both countries safe. There is a sense, and if you think about it, you'll understand the sense. This equilibrium is unsafe, is unstable. If you think that everyone's going to go a little bit into country 1, then country 1 becomes safer, and then everyone runs off into country 1. Okay? So if I compare across these two equilibria, you observe that the return from the investor side of country 1 is strictly higher in this equilibrium than this equilibrium. Why? Because there's more bonds outstanding. You get a higher return. Everyone pooling their money to buy Canadian bonds drives down return in Canadian bonds. Everyone pooling their money to buy US bonds gives you a higher return because there's lots of US bonds. So investors like this thing better than this thing. So there's the sense in which size matters in here. What hasn't come out in this model that I've gone through with you is that rollover risk matters. And I can't do that because I have lots of funds available. So I'll do that next in the next couple slides. So what I'm going to do next is, this is a special case. I'm going to build a full model. And the full model is one in which I'll be able to link things like how much funding is available, the fundamentals of the country, to equilibrium determination. And the way we're going to do this is to just follow basically Morris and Shin. All right. I'm going to break common knowledge and in the following way. So remember, 1 minus theta 1 and 1 minus theta 2 are the funding needs of country 1 and country 2, how much money they need in order to roll over their debts. We're just going to parameterize that as follows. It's equal to 1 minus theta, some world average funding need, times a component that just reflects a wedge between these two things. Okay? And the normalization here is delta tilde reduces country 1's funding needs and increases country 2's funding needs. So higher delta tilde is good country 1's position, lower delta tilde, good country 2 position. Okay. We're going to assume that delta tilde is unknown. Every agent receives a signal delta j, which is delta tilde plus some noise. All right. I'm going to be focusing on a kind of extreme case. So we need delta tilde to have a wide enough support, but we can handle any CDF. So in particular, think about the following CDF. It's single pointed at a value that places country 1 being the safe country. So that is to say, we're all very sure that country 1 is the safe country. It's a wide CDF, but we're pretty sure that country 1 is the sure country. And then moreover, I'm going to take epsilon j, which is normal negative sigma sigma. I'm going to take the limit as sigma goes to 0. So our signals are all almost exactly the same. We're almost sure that country 1 is the safe country. And that's the case I'm going to look at. This is still an interesting case because with coordination, what happens is everyone is concerned to guess what everyone else is going to do. And so what matters is everyone's going to be asking the question, I get a signal. Is my signal the best of everyone's signal or the worst of everyone's signal? So as long as we're still in this limit where there's some ranking of signals, which is preserved as sigma goes to 0, all of the economics in the model will work out. OK? All right. So here's 2 graphs to show you kind of the strategic substitutability, strategic complementarity trade-off in this model. What I'm graphing on the x-axis here is the measure of agents investing in a given country. And this was supposed to be red, but it's black. The country 2 return is the return on investing in country 2 bonds as a function of how many agents are investing in country 2, and the same for country 1. So the first thing you see is in order to be able to successfully roll over the country's debts, country 2, which has a smaller amount of debt, needs less agents to invest in it. Okay, the point here is to the left of country 1. Why? There's just less debt outstanding. So that's one issue that pops up in the model. The second thing that pops up in the model is if you pass the threshold of enough funds to roll over debt, country 2's return falls off faster than country 1's return. Why is this? Just there's more stuff outstanding. So I'm going to think of this as sort of a depth effect. So size here, float, has 2 effects. One is lots of float means big rollover risk, but lots of float also means more depth. All right, and those 2 things are going to drive the results. Okay, so we're going to compute the equilibrium as follows. I'm going to describe an equilibrium in threshold strategies. So a strategy here is an investment of agent j into country 1 or country 2 as a function of a signal delta j. Phi is this function that maps signal into investment decision. A threshold strategy is one in which if delta j is bigger than some threshold delta star, I invest in country 1. If delta j is less than some threshold delta star, I invest in country 2. Okay, so that's the strategy I'm going to be looking at. With these strategies, you're going to get a single survival equilibrium. Either country 1 survives or country 2 survives. So I'll just say this very quickly. If you look within the class of monotone equilibria, that is functions phi which are monotone, this is the only equilibrium that survives. If you look at non-monotone strategies in which this function phi is non-monotone delta j, there's another set of equilibria which I will talk about briefly in a few slides. All right, so let me construct this this equilibrium. So the way to construct this equilibrium is you got to go to the guy whose signal is delta star. And he has to be indifferent between investing in country 1 and country 2, because under the threshold strategy, if my signal is higher, I go to country 1, below, I go to country 2. Okay, so we can just focus on that threshold guy. So what does this guy do? He says, I have a signal. What I need to figure out is everyone's signal better than mine or worse than mine? Or in fact, what fraction of guys are better than me or worse than me? And he computes for every value x, a fraction of signals of guys who are better than me, he computes my profits for going into country 1 and country 2. And then he integrates over all possible fractions. And then he computes 2 profit values. So that's these 2 integrals, or pictorially, it's just the integrals it's just the area under these 2 graphs. Right? X here is the fraction of agents investing in a given country. You can just integrate under these 2 graphs. That's exactly the profit functions which we're after. It's fairly easy to do. Set those profits to each other and solve for delta star. And this is what delta star looks like. Okay. There's 2 terms here. The first term is negative, and the second term is positive. First of all, just in terms of signs here, a negative term, pushing delta star down, means country 1 is chosen as a safe asset, even if its fiscal fundamentals are worse. Right? So if delta star is low, that means country 1, US, can get away being the safe asset, even though it's running a huge deficit. Okay? So that's the way this works. So there's 2 pieces to this. The first piece is negative. That is kind of a benefit to country 1. I'm going to call this a liquidity piece or a market depth piece. And the second piece is positive, which is sort of bad for country 1. That's the rollover risk piece. I'm calling this the liquidity piece. And one thing that's important here is that this piece is multiplied by Z, where Z is defined as the amount of total funds of investors in the economy divided by the funding need 1 minus theta. All right, that's kind of the absolute amount of savings that's available in the world to chase after sovereign debt. When Z is high, this piece dominates compared to these pieces. Right, so here's a picture to talk about these effects. So let me focus on a high Z world. I'm graphing here delta star. Okay, so again, when delta star is very low, it means country 1, the US, can get away even with being the safe asset, even though its fiscal fundamentals are worse. So if you go to the extreme left of this, I'm taking my x-axis here as S, the size of country 2. You can kind of understand what's going on in this model. As you take S towards 0, you see that this delta star gets very low. What's going on? That's saying that when delta star is very low, it means that even if the US has worse fundamentals than country 2, it's still chosen as the safe asset. And why is that? It's because there's nowhere else to go. Right? That's exactly this effect, and that's why delta star is very low. As we increase S, we smoothly increase delta star until the point where I'm at the symmetric point, where S is 1, at which point delta star is exactly 0. This is a case in which Z is large. When Z is large, this market depth effect is what dominates the selection. Country 1 is kind of in this advantageous position because it's the large country. Here's the case where Z equals 0.2. And now you see we still have the same case. When S is very small, you have country 1 being advantaged. Delta star is small. But as S gets larger, in particular with S values sort of at this intermediate point, country 2 is advantaged, even if it has worse fundamentals. And why is this? Because when Z is small, there's less funds chasing after debt. So the rollover risk concern looms large in investors' minds. Maybe there isn't enough funds out there to roll over bonds. So I'd rather coordinate on the small country and make that the safe country. Okay, so kind of one first question you might ask is, when will the world switch? We're in this equilibrium in the world in which the US Treasury bond is the safe asset, so when will that end? Well, there's lots of US debt. There isn't really anything else out there that's a competition right now. Maybe Eurobonds, but that really doesn't exist, so there isn't really any competition. And Z looks large. We've been talking in the macro world about the savings glut for the last 15, 20 years, so that sort of characterizes a world in which it's unlikely to switch. We could imagine a world in which macro moves to a low Z world, in which case US Treasury debt will then be a problem. And then you might coordinate in something else, maybe Germany, which has a much smaller amount of debt. Right? I just talked about the present. There's only really one episode in the past where maybe we had a switch. So I'll just talk about this historical episode. The episode in which the world switched was when the UK fell out and the US rose. All right, so I'm graphing here a period from 1850 to 1920, and I'm graphing the UK debt normalized by UK GDP and the US debt normalized by UK GDP. So this is to show you their sizes. I'm normalizing by the same level of income. And you notice that UK debt is larger than US debt through this entire period. What you can't see in this picture, but what I didn't know until I started looking at the data, is that by 1870, US GDP is bigger than UK GDP. By 1870, the US actually has is economically larger than the UK, so its fiscal fundamentals are much better. It has less debt, it has bigger GDP, its fiscal fundamentals are better, and yet the world is still coordinated on the UK. So when did the world switch? Right around 1914. Two things happened. The Federal Reserve Act, so the Fed is created, and the second thing that happens is World War I. World War I causes UK debt to rise. It also causes US debt to rise. US debt rising with the addition of a Federal Reserve. And so our story for the switch is that the rise in debts was bad for the UK, worsens their fiscal fundamentals because their output is lower, is good for the US because there's now finally enough debt to sustain safe asset demand around the world. And so that's why the world switches. So it's an odd switch. Debts rise, but it's good rise for the US, bad rise for UK. And that persists for some period, at which point the UK drops out and the US remains. All right, another thing that comes out of this model, this is sort of almost by construction, but I just want to emphasize it. In this model, it's relative fundamentals that matter, not absolute fundamentals. Okay, so in particular, imagine another model in which there's no coordination and in which the repayment probabilities or the payoffs to the bonds are a function of the surplus theta. And so just think of two very simple functions, just debt functions, where theta is proportional to payoffs. In such a model, you will have that theta 1 matters for P1, theta 2 matters for P2. Relatives don't matter. All that matters is the absolute levels of fundamentals matters for bond pricing. This is kind of a standard credit risk model. In our model, what happens is, for the symmetric case, if theta 1 is bigger than theta 2, then country 1 is safe, country 2 is bad. If theta 1 is less than theta 2, the other case happens. That is, what matters is just the relative values of theta 1 and theta 2 to drive valuation. And that's exactly this point that the US fiscal position is worse on an absolute level, but is better than many other countries, and that's why, in some sense, the US remains the safe asset of the world. There's an extension of this logic which gets you the negative beta. And the extension is, think about a world in which I have payoffs for both countries that are weakening, but country 1 is the safe asset. So delta is very high for country 1. Absolute payoff status for both countries are falling. What happens? Well, country 2's bond value will fall because there's always a chance that it's going to default. Investors will reallocate some funds to country 1. Country 1's bond price will rise. Country 2's bond price will fall if I just decrease absolute world fundamentals equally. I'm not going to take you through the logic. It's here. But that immediately will get you this negative beta thing that I described before. All right. I focused so far on monotone strategies, so strategies in which the investments are an increasing function of signal. And in many ways, that seems to us like the most natural strategy to focus on. Now, if I open up the box to allow for non-monotone strategies, that is, strategies in which investors, as a function of delta, say invest in country 1, and then if delta goes up high, country 2, delta goes up high, they invest in country 1, and then if it goes up a little higher, they invest in country 2, et cetera. So imagine strategies in which, as a function of delta, you kind of move back and forth. And imagine I take these interval lengths and I shrink them to 0. This starts to now look like a mixed strategy. Right? I'm kind of mixing between country 1 and country 2. If you focus on these equilibria, there's another possibility that emerges, which is it's possible that you could split your funds and invest in both countries. And I think the economically interesting point is this only happens if Z is large enough. All right? So I'm graphing here, again, delta star, but now I'm graphing it against Z. Z is that world fundamental, the amount of savings available in the world. When Z is small, you still have the same trade-offs I talked about before. Right? If Z is very small, everyone's concerned about rollover risk for country 1, so they invest in country 2. As Z gets larger, country 1 starts to benefit because you get the size benefit, so delta starts to fall. The interesting thing now is above a certain threshold for Z, you enter a region, a space, in which investors allocate their funds to both country 1 and country 2, so they kind of mix their investments in a way that actually both countries are able to roll over their debts. that space gets wider as z gets larger. So there's a sense in here in this model in which if z is very large, you could actually sustain multiple safe assets in the world. Now, in those equilibria, it's still the case that country 1 is benefited. The larger country is benefited relative to country 2, and you can see that because this whole shaded region is tilted down. Tilted down in the sense that tilted down pushes up the range of deltas for which country 1 is safe and country 2 is not safe. All right, the last thing I'm going to do is I'm just going to talk about sovereign choices. So far, I've fixed the debts outstanding, and I've really solved over investor actions to determine which countries' bonds are chosen as the safe asset. So you can open up the box and talk about what will a sovereign do in response to the fact that investors account for these things in determining the safe asset. And there's two things one could do. You can look at choices over size and fiscal adjustment, fiscal fundamentals to determine safe asset. I'm not going to do that. What I'm going to do instead is I'm going to talk about security design. Okay? So the security design application is the Eurobond application, and I've already flagged this for you. There's these many proposals outstanding for creating a common euro-wide asset. And I'm going to analyze one particular version of that. Okay? So let's imagine we have two countries that issue 3 bonds. They issue a common bond, that is, they issue a portion of their bond outstanding, and they take it and put it into a common pool where they pool it with the other country's bonds. And then they issue 2 individual bonds. So there's 3 bonds outstanding, 2 individual bonds, and a common bond, which is backed by each country. Okay? In the extreme case when alpha goes to 1, that is, we can take out individual bonds, then everyone is pooled together in a fiscal union and has a single common bond. But I'm going to take the full case, which is the relevant case for Europe, in which we consider thinking about, say, Greece issuing a little bit of its own bond, issuing a euro bond, as well as Germany. Right? So that's the case I'm analyzing. Now, what we're going to study in the model is that the common bond is a pooled bond. That is to say, and there's no cross-default provisions. That's to say that if I'm Greece and I've issued a little bit of an individual bond and a little bit of a common bond, and I default on my individual bond, I also defaulted my portion of the common bond. So there's no cross-default. Germany doesn't cover Greece. You just default individually. So it's securitization rather than cross-default. And the structure is closest to the Euro safe bonds, or SB. Some of you probably know this because we have a bunch of finance economists who are the big proponents of this. You know, Marcus, Dimitri, Tano, and a bunch of other guys. So that's really what we're analyzing here. Okay. And I should tell you, no moral hazard here. I'm just going to show you how securitization can help in the structure. All right, so why might this work? I'm just going to go back to that basic multiple equilibrium model that I started out with. And in that model, if you remember, there was this no default condition. That is that bond prices had to be large enough to cover funding needs. And I showed you in that case, you get these multiple equilibria depending upon where things go. And I'm going to interpret that as thinking about when there's a flight to quality, we all rush to Germany, and we push German bond yields down and away from Greece. OK, so go back to that case that I started out with, plenty of funds available to roll over everyone's funding needs. And now let's take the case where I only have a common bond. I take alpha to 1. That is, countries issue individual and common bonds, but let's say that the proportion of bonds that are common bonds are 1. I'm going to take the limit so that there's only a common bond. What happens now? The no default condition is that 1 plus f is bigger than the funding needs of the common bond. I've already assumed that there's enough funding needs to cover the common bond. That's to say there's no default. Right? By designing a single security which pools both bonds, if there's enough funds available to roll over both countries' bonds, you ensure that there's always enough funds available to roll over both countries' bonds. So you rule out the equilibrium in which one country gets in trouble, which is a possibility in this case and is not a possibility in this case. Why is this? What's really going on? It's that the security design is coordinating investor actions. So without security design, there are 3 actions I can take: invest in country 1, country 2, or invest in the common bond. As I change the fraction of securities available, I'm forcing investors towards a single choice. And it's the extreme case when alpha is 1, I force them to only buy the common bond, so that if there's a flight to quality, you're forced to roll over the common bond, and that delivers fiscal benefits to everybody. So there's a fuller analysis in the paper in which we study the whole thing. And I'll just show you this last graph, and then I'll stop. the interesting that comes out is if you study the full case, when you vary alpha from 0 to 1, what happens is as you start increasing alpha, actually you undercut the safe asset status of country 1, the Germany in our example. And you don't get the benefits of the common bond until you increase alpha to be sufficiently high, at which space you create a space so that both countries' bonds are rolled over. In the extreme case where alpha is 1, you automatically roll over both countries' bonds. As in an intermediate region, you may or may not. So the thing that comes out of this analysis is if you're going to do common bonds or Eurobonds, do a lot of it, don't do very little. Otherwise, you undercut the status of the original country. Okay, so I'm going to stop there. I've taken through a model in which I'm talking about the determination of what is a safe asset. The analysis kind of plays off this idea that safe assets are financially engineered and their valuation is coordination dependent. That's kind of the main idea that we think is relevant for thinking about safe assets. And it's an idea that you can use to think about why it is that the US Treasury bond is the safe asset of the world. And you can also use it to think about why it is that Eurobonds may or may not be beneficial. Okay, thank you.